continue at a pace, assuming that you all understood what I say, right? All good? Right. So can you all? Yeah. Okay. Now we are trying to understand what is Forex. Forex is like basically like any other transaction. It's the process of trading currencies. So you give one currency to the place of another currency, just like you buy another commodity. Now here the issue is you are paying money to buy money. So you are paying one currency to buy another currency, paying one commodity to buy another commodity. So this is the interesting part of Forex, because you buy money for money. And why people do that? Because you can make so many gains out of this. Number two, some are for very fundamental reasons. Now, say for example, if you are buying anything from China, you are forced to pay in Chinese yuan or rand, whereas if you are a Sri Lankan or in the UAE, you have to then do a Forex transaction. Now, there are different rates which we talk about. Forex rates, we call it the spot rates, cross rates, and the forward rates. Now, spot rates are always the rates which are quoted for today. Meaning, if you want to buy a currency now, at this moment, at what rate do you work out? Now, there is a language we use to determine the spot rates. So I will use the whiteboard and show you how to do that. Now see, right? Right. Good. It kind of blood. Right. Now, guys, spot rates are written with a S, and it says an X to a quote, which is a Q, to a base, which is a B. So it's an S, Q to a B. Let me give you an example. Spot rate of Ranil. How many dirhams for a dollar these days?
3.67.
Yeah, so we say AED to a dollar is 3.67. Yeah. So guys, what is a quote? What is a base? Can somebody help us understand what is a quote and what is a base? What is meant by a quote? What is meant by a quote and what is meant by a base? Just simply by trying to understand the 3.67. Can someone non-finance try to explain this? Anybody want to have a go at it? We'll get an extra mark at the examination.
Most of
No one wants to go?
Switching off they must have switched off their microphone.
Oh, they have switched off their microphones.
You have to
right.
switch it off and talk.
Right. Now what happens here, a lot of people misunderstand this as the quote is the weaker currency and base is the stronger currency, which is wrong. Quote can be any currency, whereas the base can be any currency. The secret to this is that the base is always for 1 unit. Yeah, the base is always for 1 unit, meaning we are paying $3, 3.67 dirhams to buy what? To buy 1 unit of dollar or $1. Now this is very important. Later on in our studies, you will need this knowledge. Base is always 1. So we are paying 3.67 dirhams to buy $1. Now if dirham depreciates, this value will go up if dirham depreciates. Can somebody explain to me why that is using the base and the quote language? Why if dirham depreciates that the 3.67 will go up? Anybody? What happens here is that if the dirham depreciates, you will have to pay more dirhams to buy the same dollar. Now that is what is called a depreciation of currency. See, earlier we paid 3.67 dirhams for $1. Now we are paying, example, $4 to purchase $1. So what have we done? We have paid more dirhams to buy the same dollar. So when you write this quote-based language, it is very simple for us to understand whether the currency depreciates or appreciates. Now what you see here is a depreciation. Earlier you paid 367 for $1. Now you are paying 4 for $1. What if you are paying 2 for $1? Has the dirham appreciated or depreciated?
Appreciated.
The dirham has appreciated. Why? Earlier you paid 367 to buy $1. Now you only have to pay 2 to buy $1. So quote-based language is always very interesting. Can you clear this for me? Can you clear this for me? So let me write another one. Let's see whether you can. Right. Let me say whether, let's just check whether you can figure this out. Now the spot rate for LKR, which is the Lankan rupee, to a dollar is 150. Right, I know you cannot talk to me on this, but can you figure out what this means? What does the 150 means here? I'll give you 2 seconds to figure that out. If you have thought this right,
150.
exactly, to buy $1, you have to pay 150 rupees. Now, if the dollar is to appreciate, this 150 will go up to 152, meaning we have to pay more rupees to buy the same dollar. If the dollar is to depreciate, then this will fall to 148, meaning we have to pay less rupees to buy the same dollar. Now you must have wondered, should the dollar or the pound, for that matter the euro, being stronger currencies, should they always be the base? No, they need not be the base like this. I can write S dollar to a LKR. What does this mean, guys? Can you figure out what this means?
How many dollars you have to pay?
Absolutely. To buy a rupee, if you are a US guy, if you want to do a transaction in Sri Lankan rupees, to buy a rupee. Now see, this is a rupee. This is a rupee. 1 rupee. To buy a rupee, how many dollars you will have to pay? Which will exactly be the inverse of this, which would be 0.006 or something. So you will have to pay $0.006 to buy a rupee. So now you would figure out the code-based language. Do we have any questions on the code-based language? Any questions? Anybody? All good?
All good.
Yeah, so I'm going to have some fun at the examination, asking you to, figure out some simple quotes bases for a couple of marks. Yeah, right? And then what does it mean by the cross rates? Now these are the spot rates. Now what do we need by what do we mean by the spot rates? Right? Right. Now cross rates means if you know the relationship between A to B, further if you know the relationship between A to C, you can mathematically figure out the relationship between B to C, which is more logic than Forex. If you are right, okay. Now see, if you look at what is appearing on screen now. Now see, we know what are the rates for $1 for euro, British pounds and Indian rupees. Further, we know for €1, what does it mean by dollars and Indian rupees. And then further, we know for a pound, what does it mean by a US dollar, euro and INR. Got it? So now can all of you write in a piece of paper, can all of you write in the S language, can all of you write as euro to a dollar? Can you write the value? S language, write the symbol and write the value. I want S, euro to a dollar. Euro up, dollar down. Euro quote, dollar base. What did you write? Did you write 0.7753?
No.
That's the S, euro to a dollar. Got it? Can all of you write in the S language, Indian rupees to a dollar? Indian rupees to a dollar. So rupees up, dollar down. Rupee quote, dollar base. Did all of you write 46.5212? Yes? Right. So what you wrote, can I go back to my writing board? So what you wrote is, right, what you wrote here, oh, මට බලා ගන්න ඕන. දැන් ඒගොල්ලන්ට එතකොට ආයි මාරු වෙනවද PowerPoint? නෑනේ. ඒක පොඩක් දාන්න. What you wrote here is the S of earlier euro to a dollar. And that was 7753. Brilliant. Further, you wrote the spot of INR, which is Indian rupees, to a dollar, which is 465212. Brilliant. Now, using these two relationships, can I work out the spot rate of INR to a euro? Can I work out the spot rate of INR to a euro? So basically what we do is we divide the spot rate of euro to a dollar by the spot rate of INR to a dollar. Then, like you studied in grade 1 mathematics, this dollar and this dollar gets cancelled off, guys. Simple, no? Right? So what you get is a euro to a INR. See, a euro to a INR. By simply dividing this, you will get a euro to a INR. Got it? But what we need bottom here is INR to a euro. INR to a euro. But what you are getting by simply dividing this is euro to INR. Euro is at the top. INR is at the bottom. But what you need here is INR at the top and euro at the bottom. So you need to do a inverse, boss. You need to do a, I didn't, got it? All right. It is, right. Right.
Okay.
Right. You need to do an inverse of 0.7753 by 465212. Yeah. Why did we do an inverse, guys? Because what we get here is a euro to a INR, but what we really need is an INR to a euro. So basically you will get an answer as 60 if you do this right. See, we use the relationship of two currencies to work out another currency. Are we good with this?
Yeah.
Yeah, anybody has problems, issues? So you think it's okay if I use this at the examination and have a little bit of fun with you guys, huh? Right? Give you a couple of currencies, get you to calculate the cross currencies here, there. Are all okay with this? Can I get a confirmation?
Confirmation, the mics are mute.
Mr. Atauda, you okay?
Can you take this same example once more?
Can I explain the same thing again?
Yes.
Or should I do a different one so you will understand it better?
Okay, either way.
I'll do a different one. It's always good to explain a different example, right? Okay, now everybody who's logged in, all 20 people, please do this with me, right? Please do this with me. Don't wait until I write this on the board. Please do this with me, right? Okay. මට මේක දෙනවද මගේ cross rates ටික? Good. Right. Can everybody write? Okay, so do this with me so you'll understand better. Huh? Right. Can everybody write the cross rate of dollar to a pound? Dollar to a pound. Cross rate of dollar to a pound. Right? If I write it, it's the spot rate of a dollar to a pound. And if everybody got it right, it has to be 15470.
Yeah.
Right. Dollar to a pound. Yeah. Then can everybody write euro to a pound? Can everybody write euro to a pound? Euro to a pound. Euro to a pound is 11994. Yeah? Are we good with this?
Yes.
Right. So did all of you write 15470 and 1994? 11994. Now what I want to figure out, guys, using these two, switch karana. What I want to figure out by using these two, I want to figure out the spot rate. I want to figure out the spot rate of dollar to a euro. Can you figure out a spot rate of dollar to a euro? Mata make it scratch board. Can you figure out the spot rate of dollar to a euro? Everybody, dollar to a euro. Dollar to a euro. Dollar to a euro is simply dividing one by the other, isn't it? Then what happens here is the pound and the pound gets cancelled off. And wow, not like the last time. This time we got exactly the dollar to a euro. This is exactly what we need. Spot of a dollar to a euro. Then ගිය සැරේ වගේ මේක අනිත් පැත්ත ගහන්න ඕනේ නෑ. මේක ඒ විදිහටම ඇවිල්ලා තියෙන්නේ. Last time we had to do a inverse. Here beautifully we got the dollar on top and euro at the bottom. So this is simply 1.5470 by 11994. So we have a dollar to euro. Are we good? The person who asked the last time the question asking me to repeat this, is he happy? Not happy, yeah?
It is clear.
It is clear now? Good, yeah? So you will be given some opportunities at the examination to do some simple stuff, because your question number 1 would be with capital budgeting, 2 would be with what? With mergers and acquisition. By the time you do the first 2 questions, you'll be very tired. So I'm going to give you something simple like this to catch your breath and catch some time. Yeah? All good? Yeah? Right. Fantastic. Now what we are going to do next, having studied this, I'll come to forward rates a little later. What we are going to do now is to have some fun and explain to you some very fundamental theories related to Forex. Now these theories are so simple, so basic. You might wonder for a moment, is this worth discussing at an MBA class? But later on you will realize that this is like the cornerstone of some very, very advanced theories, and you can explain any movement of Forex through this very simple mechanism. All right, any movement of Forex through this very simple mechanism. All right, so I'm going to take about 10 minutes to explain to you about something very interesting using economics and finance, which is like my absolute specialty area, economics and finance, right? So I'm going to switch to the scratch board. So you would see some scribbling by me, and it is okay for you to copy this. It is okay for you to copy this. It makes sense. All right, guys, good. Now, the fundamental principle here is that the prices in this world are all at an equilibrium. And if the prices become in equilibrium, then Forex rates jump into in equilibrium to bring back the price equilibrium. I can now judge your reactions. You must be thinking, what? You didn't understand any of this, huh? Any of this. Now let me slow down and see whether you can figure out something, huh? The prices in this world are at an equilibrium. If there's an inequilibrium, then forexers will jump into an inequilibrium to bring back the price equilibrium. I think now it might have made some sense. Now let me talk English. All this time I was talking Greek. It says prices in this world for a standard product are all equal. If the prices are not equal, then Forex will adjust by itself to bring back the equal pricing. Now it makes sense, huh? Right? So I'm going to use the scratch pad and show you something interesting. It is okay for you to copy this, right? Let's talk about, guys, a baseball bat. This is interesting. Maneuvering this is nice, right? Let's talk about a baseball bat. Baseball bat. Yeah, right. Now, guys, there is a baseball bat in the UK and there is a baseball bat in the USA. Yeah, the UK baseball bat is 5 pounds. The UK baseball bat is 5 pounds. Yeah, and the spot rate, now you know the language, guys. The spot rate of dollar to a pound is 2. Spot rate of dollar to a pound is 2. If so, for there to be a price equilibrium, how many dollars should the same baseball bat be? ඒගොල්ලන්ට පේන්නේ මොකද්ද? මොකද ඒගොල්ලන්ට පේන්නේ? ස්ක්‍රැච් පෑඩ් එකද පේන්නේ?
Yes.
Sure නේ? Scratch pad ඒගොල්ලන්ට දැන් දිගටම scratch pad පේන්න ඕන, right? How many dollars should this bat be in the US dollars? Guys, everybody make a guess. 10. Absolutely right. Now if I write 10 here, are we at a price equilibrium?
Yes.
Why do we say we are at a price equilibrium? Because the same baseball bat is 5 pounds in the UK, 10 pounds in the USA, and the currency rate, exchange rate is $2 to a pound. So the bat is of the same cost between UK and USA. We are at a price equilibrium. Now let me break the equilibrium. I'm breaking the equilibrium to an inequilibrium with the same rate, and now it's $10. Guys, now are we at an equilibrium? No. Which country the baseball bat is expensive?
UK.
UK, the baseball bat has been expensive. It's £6 into 2, it's $12 equivalent, whereas in the US, it's only $10 equivalent. So the natural tendency is for the entire UK population, entire UK population to get into a queue. To get into a queue. කොහේ යන්නද?
Go to US.
To go to US. To do what, guys?
To buy baseball.
To buy the bloody baseball bat. So if you ask this queue of people, they will reply to you by saying, we are going to United States to buy the baseball bat. Does it make sense?
Yes.
Yeah, it makes sense because they are going to a place where the bats are cheaper. So they can trade, buy, speculate, make some money. So the whole UK population is now queuing up to go to US. There is a problem. What is the problem? At the US border, they need to change their currency. They have pounds in their pockets, but in United States, pounds are not accepted. In United States, only dollars are accepted. So at this level, they need to sell their pounds. They need to sell their pounds and then do what? They need to buy the dollars. Guys, why do they have to buy the dollars? Yeah, to buy the baseball bat. And why dollars? Because in the United States, only dollars are accepted. So at the border, they have to sell their pounds and buy the dollars. Now, what is being sold here?
Pounds.
What? Pounds. And everybody is selling. Everybody is selling. So pounds are in over supply. Now you know where I'm getting into. Pounds are in oversupply. What is in demand, guys?
Dollars.
Dollars are in demand. See, a very complex exchange rate situation is explained using very, very simple economic fundamentals. When something is in demand, what should happen to that price? Price should increase, guys. Price should increase. And when something is in oversupply, what should happen? Price should decrease. දැන් හොද්දට කල්පනා කරලා මේ උත්තරේ දෙන්න. හොද්දට කල්පනා කරලා, right? When pound falls, dollar increases, what happens to 2? හොද්දට කල්පනා කරන්න. When pound falls, dollar increases, what happens to 2? 2 උඩට යයිද 2 පල්ලයට යයිද? 2 will come down. Why? Let's go back to the fundamentals of spot rate. Spot rate කියන්නේ how many quote to buy a base. අපි මේ කොහමද ලියලා තින්නේ? dollar quote pound base. How many dollars to buy a pound? How many dollars to buy a pound? Earlier you gave $2 to buy a pound. Now you will give less than $2 to buy a pound. Why? Pound is depreciating, dollar is appreciating. Now you will only pay 1.667 to buy a pound. Pound has dropped, dollar has appreciated. Now we bring back the equilibrium. 6 pounds into 1.667 is $10. We have brought the equilibrium back. Polymer isara hitapu aya bats aran gedera yanawa. Polymer pitipassa hitapu aya bats ganna nathuwa harila gedera yanawa. Why? There is no more advantage of buying the bat. Exchange rate has come back to its equilibrium to bring back the price equilibrium. Beautiful, isn't it, guys? Anybody who couldn't understand this? Amazing, huh? Anybody who couldn't understand this? Mr. Atauda, you okay? No? Ranil, you are good?
Yeah, I'm fine.
Yeah, all good. Right. Where is our famous and loving couple? Can I hear from them?
Only husband is
Are
around.
they? Only husband is around.
Thank you very much.
Good.
Obviously, they can share
Loveliness,
one
man.
login.
Right. The IT guru. How are you? Good, or like in the class you are always inquisitive and not happy?
No, I'm very much happy.
All right. Okay. Good.
Thank you.
Right. So guys, now see, we had an equilibrium 5 to 10 with 2 as the exchange. We had an inequilibrium 6 to 10 with 2 as the exchange. Now that is called an equilibrium. Then the whole country was lining up to go to US. They were selling pounds, buying dollars, supply demand problem. Dollar appreciated, pound fell to 1667 and brought back the equilibrium. 6, 1667, 10, it brought back the equilibrium. Got it? This is called single price theory. Single price theory, meaning single price prevails in this whole world. If it doesn't, then exchange rates will automatically adjust to bring back the equilibrium. Got it? Now, I'll show you something very interesting. Maybe if you have done finance in your BSc or anywhere else, you know this, like my good friend Ranil. But if you haven't done finance, you'll be amazed with this. You'll be amazed with this. Can I go back to my slides? Right, slides. Okay. They don't use baseball bats to compare because baseball bats are not used. I'll come to this later. මේ කියපු කතන්දර ටික ඔක්කොම slides වල තියෙනවා guys, right? ඔක්කොම තියෙනවා කියවලා බලන්න පුළුවන් හැමින්. They believe what you see in screen now is a fantastic item to compare prices across. What time is it in Dubai now? 6:40?
6:45.
Yeah. Have you had dinner, guys?
No, you tempted us.
Not bad, no? I also haven't had dinner. It's almost 8:30 here. Now see the Big Mac. They say, I'm not a spokesperson of McDonald's, but they say Big Mac is of equal size, equal quality, equal weight, and equal taste wherever in the world. I repeat, they say Big Mac is an equal size, equal weight, equal quality, and equal taste wherever in the world. So what a fantastic mechanism it is to measure the exchange rates through Big Mac. Now here what you see on screen again is called a Big Mac index. My Big Mac index, what I used to explain, are a little outdated, but you being the tech freaks, you can Google and find out the latest Big Mac index. Now let me highlight the data for India. Let me highlight the data for India. Can you look at the data for India and follow with me? A Big Mac in India is 84 Indian rupees. Got it? A Big Mac in the United States is $4.07. Where do you find $4.07? Right at the top, you will find $4.07. Can everybody figure out that a Big Mac in India is 84 rupees? If you have your notes, you can take a highlighter and highlight 84 rupees. That will be nice. Then go back right to the top and highlight 407, which is the Big Mac price in the United States, right at the top. Then can you come and highlight the actual exchange rate as at present, 44.4. Can all of you highlight in your notes these three numbers? 84 rupees, $4.07 in United States, and the actual exchange rate is 44.4. 44.4 Indian rupees to a dollar. Now can you figure out, everybody, and tell me in which country the Mac is cheaper? In India or in the US? Just by looking at these three numbers, 44.4, 84, and 407, can you tell me in which country the Mac is cheaper? Guys, come on, shoot at me.
India.
Absolutely, in India, the Mac is cheaper.
Yeah.
Why? In the United States is 407 and the exchange rate being 44.4, the actual conversion in Indian rupees would be some 160 odd Indian rupees, which is 407 into 44.4. But India, it's only 84 rupees. So the Big Mac is cheaper in India. Now, who will get onto a flight? Which country will get onto a flight and rush to India? Guys, which country will get onto a flight and rush to India?
Supposing.
The whole US population will now get onto a flight and rush to India to do what?
Buy Big Mac.
To buy the bloody Big Mac. What will they sell? What will they buy in currency terms at the Indian border? They will sell the dollar by the rupee. When they sell the dollar by the rupee, what will appreciate, what will depreciate? Dollar will depreciate, rupee will appreciate. Meaning, in the next 2 to 3 months, Indian rupee will appreciate. If you have Indian currency, buy it, keep it. If you have US dollars, sell it, get rid of it. simply by looking at the Big Mac. Forex traders, dealers look at the Big Mac's index and take buying and selling decisions. According to this, the 44.4 range will come down to 20.7. So Indian rupee will appreciate by 50%. It will exactly not happen as it mentioned, but at least it will move in that direction. So if you have Indian rupees, keep it. If you have dollars, sell it.
So I have a question.
Please.
Yeah. What if the fixed cost in India is cheaper than US?
What if the,
Fixed cost in India is cheaper than US.
what do you mean by the fixed cost?
When you are producing Big Macs, right? There's a fixed cost element in that Big Mac.
That's okay. For a normal consumer like you and me, whether it's the fixed cost or variable cost, it doesn't matter. What matters to us is that the Big Mac is offered cheaper in India. It's the same Big Mac, same amount of beef, same amount of tomato and same amount of bread. So we go and buy it. What matters to us is the final price. All right, guys, are you having fun with this? So at the exam, I reserve the right to give you a Big Mac index and ask you what currencies to buy and what currencies to sell. You think it's fun? Yeah, okay. Not fun, right? Guys, I'm going to change this to Argentina. I'm going to change this to Argentina. Can you tell me, going by the same logic, can you tell me, going by the same logic, should you buy Argentinian peso or should you sell Argentinian peso? I'll give you 3 minutes. Should you go by the same logic? Should you buy Argentinian peso or should you sell Argentinian peso? I'll give you 3 minutes.
Buy, I think. Sell
You have to
Argentina.
sell peso.
Sell peso.
Sell Argentina.
You sell peso and buy dollars.
What do you think, Sky? What do you think, guys? Give me some feedback. Should we buy the Argentinian peso or should we sell it?
Sell it.
Sell it.
Yeah, you
buy
should
it.
sell the Argentinian peso. Anybody who thinks that we should buy the Argentinian peso? Nobody. දැන් මේකට ඔච්චර අරෝමේව ඉරා ගන්න ඕනේ නෑ. If you go to the Big Mac index and if you see the last column always says under overvaluation of raw index. If that is minus, buy the currency. If that is plus, sell the currency. Look at the last column. If the last column is minus, meaning the currency is undervalued, buy the currency. If it is plus, meaning the currency is overvalued, sell the currency. It even tells you but by what percentage the currency is undervalued or overvalued. Big Mac index says that they do not take the responsibility on the exact percentage of over undervaluation, but there is some method to madness in the way currency is moving. So if you want to make a little bit of money, easy money, have some Forex accounts, look at the Big Mac index and move accordingly, guys. You know, there are people who have become billionaires simply by doing that. So you don't have to waste your time in the desert trying to earn money. You can do things like this. Of course, there have been instances where the Big Mac index had gone terribly wrong. Now, why I specifically took the 2011 as an example is according to 2011 Big Mac index, they say Indian currency is appreciating and the US dollar will depreciate. But what happened exactly in the Indian economy is exactly the opposite. Exactly the opposite. You know? So there could be situations where the Big Mac index can go brutally wrong, but the research says this is good about 60 to 70% of the time. If you are a gambler going to Las Vegas with about $5,000 in your pocket, and if there's a gambling place, I'm sure most of you all have gone to Las Vegas and gambled. If there's a gambling place which says 70% chance of winning, I'm sure all of you all will go there. Even though there's a 30% chance for you to lose, I think most of you all take the 70% chance. So Big Mac is also about 60-70% accurate. Questions? So I might reserve the right to ask you a question and say, explain how a Big Mac index work. So you might have to write back to me and tell me a little about the single price theory. When the prices are at in equilibrium, then the exchange rates will bring back the equilibrium, no change for a Big Mac, and blah, blah, blah story, and how it works really in practice. Can we go back to our scratchpad? Right, I think you are now seeing the scratchpad on the screen.
Not yet.
Not yet? All right, good. Super. So what we are trying to say here if we delete all this rubbish, yeah, let me resurrect this. That's all, and this has fallen to 1667. Huh? Right. If I delete all this rubbish, prices going 5 to 6 is inflation. And another fantastic theory. Inflation. In a country where there is inflation, what will happen? What will happen? In a country where there is inflation, currency will depreciate. In a country where there is inflation, currency will depreciate. Now I'm taking all the other rubbish out. And focus on this. And I'm going to say, in a country where there's inflation, currency will depreciate. Sri Lankan inflation is always 10%. US inflation is always 2-3%. Which country has high inflation? Sri Lanka. So that's why Sri Lankan currency is always depreciating and US currency is appreciating against the Sri Lankan currency. Yeah. So we come to, can we go back to the slides? A very interesting theory called the purchasing power parity theory. If all of y'all can focus on the slides, that is the future rate of A to B, මතක තියාගන්න A උඩ B යට is the spot rate of A to B, again මතක තියාගන්න A උඩ B යට multiplied 1 plus the inflation of A divided 1 plus inflation of B, මතක තියාගන්න A උඩ B යට to the number of years. See the pattern here, guys. If you are not from a finance background, see the future A උඩ B යට, see the spot A උඩ B යට, see the inflation A උඩ B යට. Got it? Are we good with this? I'll show you how this is applied into mathematics, which I'm going to have loads of fun at the exam. All right, good. Can I go to the scratch pad? Good. Let me tell you that the spot rate of LKR to a dollar is 150. Further, let me tell you, inflation in Sri Lanka inflation in Sri Lanka is 10%. 10%. Let me tell you, inflation in the USA is 3%. So what will be the future rate of LKR to United States dollars in 3 years? What is the future rate of LKR to a dollar in 3 years? Got it? That is, refer to your notes, A would be at A would be at. So you need to maintain the same A would be at relationship throughout. A would be at LKR would dollar at LKR would dollar at. So here 150 is also LKR would dollar at multiplied by A would be at 10% is up, 3% is down. 1 plus the percentage to the power number of years. So this will be how much, guys? Does anyone have a scientific? Now, did you all borrow scientific from your daughters, nephews, nieces? Yeah. You get about 182? Is 182 good? So if this is the only thing which is determining the currency rates, in 3 years' time, Sri Lankan rupee will go up to 182. Make sense? Questions? Questions, anybody? Good. So shall we take a 5-minute break for you all to do your bio stuff and all that? 5-minute break. It's now, I think it's 7:15, 7:14. Is that good? Shall we log in or come back to your terminals in 5 minutes?
Yep.
Yeah, all good? All right, search together. Sometimes exchange rates are driven by interest rates. Sometimes the exchange rates are driven by inflation. Sometimes the exchange rates are driven by demand and supply. Likewise, sometimes the exchange rates are driven by the trade balance. Now, how trade balance drives exchange rates? Simply, if a country has trade balance, like Japan, a positive trade balance, then meaning Japan will have more exports than imports. That's why they have a positive trade balance. More export than imports. So when you have more exports, you get more yen into the country, less imports, less yen going out of the country. So that leaves more demand for the Japanese yen. As a result, the Japanese yen appreciates. So very simply, when a country has positive trade balance, the currency appreciates. When a country has negative trade balance, the currency depreciates. Now, if you take a poor country like Sri Lanka, the currency always depreciates because everything is against us, whether it's the trade balance, or whether it's the interest rates, or whether it's the inflation, or whether it's anything else, it's against us. So that's why the Sri Lankan currency is ever depreciating. So it's important for us to understand how each country's currency depreciates and why. In a case where if you take a very awkward situation like the tsunami period in Sri Lanka, which is a memory which we do not want to go to, but even reluctantly if we go there, during tsunami times, there were a lot of foreign aid coming into our country, lot of foreign aid. Then the Sri Lankan government, knowingly or unknowingly, put a rule saying any foreign aid cannot be held in foreign currency. It has to be converted to rupees on the spot. I think that's a very smart move. Meaning, let's say the Sri Lankans who live in Dubai, people like y'all, were so sympathetic and you sent $1 million. That $1 million cannot stay in dollars. Moment it hit the boundaries of Sri Lanka, had to be converted to rupees. I think that's a very smart move by the government. So we had millions of dollars coming in as aid, everything converted to rupees. For a very rare situation, we had dollars being sold and rupees being bought in quick time. And that's one rare situation where the Sri Lankan rupee appreciated by about 20%, which we were all very proud of. But it is based on a very sad and unfortunate circumstance for Sri Lanka, so nobody had the mindset to celebrate. So this is, I don't call it a good example, but it's a very fundamentally strong example to explain how demand and supply drive exchange rates. So what we have been discussing over the last 1 year is to see how different factors pull the exchange rate into different sides. And clever individuals keep a track of all this and guess exactly where the rates are moving and thereby sell and buy rates to make a little bit of money. And as MBA students, it is always handy to understand how the currency is moving here there and what logic drives them. Do we have any questions?
No.
Anybody? Any questions? All good? All right. Now let's talk about, for 5 minutes, about the forward rates. Let me go back. Right. If you all can see your notes, I think your notes are not interactive, so you have the whole diagram in one slide. But if you look at the screen, especially if you don't come from a finance background, you would understand this better. See, let's assume a situation where there is an exchange rate fluctuation by 1st of January to a level where it's 130 Sri Lankan rupees to a dollar. And you need to do a transaction where you will have to buy dollars and sell Sri Lankan rupees. So you are scared. If you can look at the screen, you will see how the movements are going. You are scared by 1st of March, the dollar rate will appreciate and rupee will depreciate simply by extrapolating the future into the extrapolating the past into the future. So you are worried that the red line will take place, and you will lose out in currency conversion. Therefore, you go to a bank and ask for a forward rate. You see the forward rate? So when the free market may be working at 136, a bank can give you a 132 rate. Yep. What does this really mean? This really means that when the free market works at 136, the bank has an obligation to sell you dollars and buy your rupees at 132. So you have hedged your risk at 132 by signing an agreement with a bank. If you are successful and if the market moves exactly the way you anticipated it to move, when the whole world is buying dollars at 136, you will be happily buying dollars from a bank at 132. So you are a hero. This is exactly what Asantha Dimel in Sri Lanka was trying to do for Ceylon Petroleum Corporation, trying to buy barrels of oil. When the oil prices were going up, he hedged the oil. So he thought when the whole world is buying oil at a high price, that he can buy oil at a lower price for his country. His intentions were good. The only difference between my example and Asantha Dimel is in my example, we are trying to buy dollars, but in Asantha Dimel's example, he was trying to buy oil. But what if the dollar rate comes down? Look at the second red line. Nobody can predict the future to accuracy. What if the dollar rate comes down? Then when the whole world is buying 128, you will be crying and buying dollars at 132. So here you are losing out. And the challenge is we do not know where exactly the free market will move. Yeah? So if the free market moves upwards, your forward booking is good. If the free market moves downwards, your forward booking is not so good. So here, by trying to hedge using forward rates, you could either lose or gain in the process. This is exactly what happened to Asantha Dimel. When he thought that he could be a hero, trying to save the country by forward booking, unfortunately, not his fault, unfortunately, the free market fell for oil, and when the whole world was buying at a lower price, he still had to buy at a forward booked price. Do we have any questions on the forward rates? So how are forward rates determined by banks? Simply by buying and selling mechanisms. I know it's very difficult for me to explain this over mLearning session. In a classroom, this would have been fun. How does banks take this risk? Actually, banks don't take a risk here. They take zero risk. I want you to picture this beautiful example, right? Assume that I get a call from Hilton and ask Ravi, can you supply us 1 million bananas in February? So Hilton is calling Ravi asking for 1 million bananas. What is Ravi going to say? I don't have a single banana at home and I'm not a banana farmer either. What is Ravi going to say?
Yes.
I'm going to say yes. Who am I? I am the bank. Who is Hilton? Hilton is a customer. And here Hilton is asking me for bananas. Likewise, a customer is asking dollars from a bank. The bank do not have the dollars, but the bank says yes. Likewise, Hilton is asking bananas from me. I do not have bananas. I say yes. And I agree to sell bananas to Hilton in 2 months' time at $2 a banana. I don't have a single banana under my belt. What an irony. In 2 weeks' time, I get a call from a farmer. Can you guess what that call is going to be?
He wants to sell
Guys, absolutely. I get a call from a farmer and say, Ravi, I have 1 million bananas to sell. Can you help me? So who is the farmer? Another customer. Who is me? The bank. So beautifully, the bank tallies these two. Here I have Hilton wanting to buy bananas or dollars. Here I have a farmer wanting to sell bananas or dollars. So what do? I agree to sell to Hilton in 2 months' time. At the same time, I agree to buy from the farmer in 2 months' time. Beautifully, the dates match. Volumes match. Then what do? I say I sell Hilton at $2. I buy from the farmer at $1.95. I make a beautiful 5 cents profit. I didn't even touch a banana, but I made 5 cents into $1 million profit. This is exactly what the banks do. They get requests to buy dollars. They get requests to sell dollars. The treasury matches the request of buying, selling to timing. And if there are small mismatches between buying, selling, and timing, they hold a stock. And that stock is their foreign currency reserve, simply to offset the timing. So this is how banks make money, simply by buying and selling. And by going forward, they don't take a single risk. Do we have questions, guys?
No.
Guys, anybody wants to ask questions?
So what happened if this timing and if this opportunity doesn't arise for the bank?
Then you are not a popular bank then. Because if you are a popular bank, people should continuously walk into you and ask for dollars, pounds, euros, AEDs, dirhams, and use your trading team, which are called the treasury team, should be very cleverly match them. In case if you can't match exactly your buying to selling, then you are having reserves of dollars, euros, pounds, dirhams, and those reserves can be used to bridge short-term gaps. Now, in my previous example, my volumes beautifully match. I had Hilton calling me for 1 million bananas. At the same time, I had a farmer calling me to sell 1 million bananas. But in the real world, fairy tales don't happen like that. Here, I may be having 100 hotels asking me 10,000 bananas, 20,000 bananas, 50,000 bananas, 100,000 bananas. And I will have 100 farmers ready to sell me 5,000 bananas, 50,000 bananas, 75,000 bananas, and 60,000 bananas. So my clever treasury department will match these little pieces between buying and selling. Got it? Now that's the very tough job of treasury, trying to manage and match the demand to supply, not current but future. That is what is called forward. So if you are scared of your exchange, you can book. Now, say for example, you buy an apartment in Sri Lanka, and you are scared that by the time the apartment finishes, you will have to pay more because Sri Lankan currency appreciates, which is a dream only. If you scare like that, then you can take a forward booking to buy Sri Lankan rupees against dirhams. You know?
Yeah.
Now, there you can only gain or lose by going for 100% forward booking. But clever companies, they do not want to gain or lose, they simply want to hedge and keeping their profits or losses to zero. What they do is they adopt a very clever technique called 50% hedging. 50% hedging means you only hedge with a forward booking 50% of your transaction. The balance 50%, you allow it to happen in the free market. So when 50% hedge and 50% is free market, whatever the gain from hedging is offset from the loss in the free market. Or whatever the loss in hedging is offset from the gain in the free market. And you basically lose nothing, you gain nothing, but your currency is beautifully hedged. This technique is called half hedging. Are we good with that? Yeah? But actually, in the real world, very few companies go for forwards. They believe that forward is a very expensive tool, and it's a very complicated tool because you need to sign an agreement with a bank. And signing agreement with lawyers and all that is not a very pleasant task. So a lot of companies are using internal grandmother methods for hedging. They don't go to banks to hedge. This is called disintermediation. Intermediation is like a bank mediating. Disintermediation is that you are trying to do it without a bank. Disintermediation. I'm sure most of the bankers in the audience wouldn't like this because you are trying to cut off a bank and try to hedge your own currency exposure. How? I'll tell you how. If I quote this beautiful example of Maersk. Have you all heard of the Maersk shipping line? Yeah. Now Maersk have these big ships. They go from the east-west trading line, which is the east from China, and right up to west, which is the United States. And these ships are so big, they have a big belly where they can pump fuel. They only need to bunker once in this whole journey. So you can go from the west of the world, sorry, east of the world, right up to the west of the world with only one fueling. Amazing, isn't it? You can travel half the world with only one tank of fuel. So you can imagine how big this fuel tank is. Now, I know this is a foolish question to ask from a set of Dubai students. In this east-west line, you have the option to pump fuel from anywhere in the world, starting from China right up to United States. Where would you pump your fuel from, guys?
Saudi.
Absolutely. You will pump your fuel from Saudi. Why is that, guys, if I ask you?
Cheapest oil.
Absolutely, that's where the fuel is cheapest. Do we all agree that the fuel is cheapest in Saudi?
Yes.
So, pump your fuel in Saudi. But what a surprise, what a surprise that Maersk pumped their ships in Rotterdam. Now you must be thinking, what? Why Rotterdam? Can anybody figure out a logic for this?
That's a hub. Being a hub,
That's being a hub.
they have the economies of scale when it comes to oil.
That's a hub. They have the economies of scale. Yeah, makes a little bit of sense, but not really. Why do they go past Saudi and fuel at Rotterdam?
Not only oil, other facilities also can be accommodated there. Water, food, ship.
Think from a currency point of view. Our lesson today is Forex. Think from a currency point of view. Our lesson today is Forex. Guys, Maersk collect most of their revenue in euros. Maersk collect most of their revenue in euros. And they prefer to pump fuel also in what? In euros. So they don't have a conversion risk. If they pump in Saudi, they will have to pay for their fuel in Saudi currency. Here, they collect their revenue in euros, they pay for their fuel in euros. Their CFO very cleverly match the revenue to costs and ensure no conversion, therefore no exposure to currency risk. Clever man, huh? Or clever woman. We don't know what gender that person is. This simple technique, it's a grandmother technique, is called matching. Matching. What is matching? You try to match as much as possible expenses to the same currency of your revenue. Very simple concept of matching. Do you go to a bank? No. Did you take a forward? No. Did you sign an agreement? No. You are simply managing the currency by yourself, by matching. Make sense to you? Yeah? would you
So
believe?
one question.
Yeah.
Now they can now today we are living in a globalized world. They can collect whatever their revenues in Saudi also, right?
Okay.
So why can't they convert it and pay a lesser amount of dollars in Saudi rather than going to Netherlands?
Very good question. But the amount of money they collect in Saudi Riyals is not sufficient to pay for the fuel, because fuel is one of their largest expenses. So they can't avoid a currency risk. Part of the currency will have to be converted to Saudi Riyals, because what they collect in Saudi Riyals as revenue is not enough to pay for the fuel.
Okay.
Make sense? Now, there are very simple grandmother techniques. Matching is one. Now, second, I forgot to tell you, matching is the most popular hedging technique in the world. Most popular hedging technique in the world, and very bad news for the bankers, because they don't come to a bank to do this. The next most popular hedging technique in the world is leading. Leading means if you think that the currency is going to depreciate in the future, you do the transaction faster, in advance, lead the transaction. If you get to know that in 2 weeks time the currency is going to depreciate by looking at the McDonald's index or whatever, තව සති දෙකක් ඉස්සරහට කරන්න තිබ්බ transaction එකක් ඉස්සරහට ගන්නවා අදට lead කරනවා, leading the transaction. අද කරලා ඉවර කරලා දානවා. Let's say your son admitted to a US university, and son just called and said, Papa, I need to pay $100,000 as my university fees. You check what is the dirham rate to dollars today, 3.67. But කවුරු හරි කියනවා බලාගෙන in 2 weeks time මේක depreciate වෙනවා 4කට කියලා. So you quickly pay your son's school fees today in dollars and finish this off, rather than waiting for 2 weeks. You lead the transaction. So simply by adjusting the timing, by changing the timing, you can avoid the currency risk. Okay, අනිත් පැත්ත තමයි lagging. Lagging means you delay a transaction till the currency is right. Earlier you advance a transaction, that's what's called leading. Now you delay a transaction. Leading, lagging. You would be surprised if I tell you leading, lagging, matching are the 3 most favorite, popular, common hedging techniques in the world. You go to a bank after trying all these 3. Yeah. Then comes these all forward rates and futures and stuff, which are a bit complicated and sometimes not very practical also. Got it? Questions? Good. Right. I have one more small thing to explain, guys. Then I'm going to close the session. Thank you for your patience. Now, if you can come back to the forward rate slide again. Can they see this? If you can come back to the forward rate slide again. Now, there is a nice technique called options. Options, right? Options means you only take the contract if it is favorable to you. If it is unfavorable to you, you don't exercise the contract. Let me take one line out from here. Make a escape control. Right. Make escape karla. Right, guys. Delete. Right. Now, guys, I booked. I know you don't have this facility in your slides, so you can look at the screen. I booked at one. You can also delete it. Then you can see how you are going to resketch the graph. I booked at 132, but I actually didn't take a forward. I actually took an option. I took an option. I didn't take a forward. I took an option. Thinking the free market will go to 136, I took an option at 132. But wow, the actual market came down to 128. The beauty here is, since I didn't book a forward, that I booked an option, I have the option to buy from the free market if I want. I am not forced to exercise that 132. So if things are unfavorable to me, I have the option not to go for that. So that's called an option. So it's an obligation by the bank, but not an obligation by the user to use it. It's like your car insurance. You will only use it if your car meets with an accident. If not, you won't use it. Now here, if you look at the screen, you booked an option at 132, නිකන් හරි මේක 136 වලට ගියා නම් you will exercise the option. But මේක 128 වලට ගිය නිසා you will not exercise the option, you will just play in the free market. That is called an option. That's the difference between a forward and an option. Forward එකේ free market එකේ මොනවා වුණත් you must come and do your transaction with the bank. Option again, you have the option whether to come or not to come. Questions?
No.
Good.
Why would a bank agree to that one?
Very good question. Very good question. Why would a bank agree to that one? Yeah, that's a good question. Actually, a bank would agree to that one by charging a premium in advance. Think of your insurance policy. අපි insurance policy එකක් ගන්නකොට insurance company මොකද කරන්නේ? What do they charge from us?
Insurance premium.
They are charging insurance premium. ඊට පස්සේ කාර් එක හැප්පුණත් එකයි නැතත් එකයි. කාර් එක හැප්පුණොත් then you come back and claim. කාර් එක හැප්පුණ නැත්නම් you don't even cite the insurance company. But what happened to your premium, guys? Premium is gone. ඒ වගේම තමයි option එකකදී you have to pay a premium in advance to the bank. So bank has already covered itself by charging a premium. So in an option, there's a premium. I have given you a nice summary of options versus forwards in the last slide, I think. Yep, last slide. Good question. All good, guys?
Yeah.
Good, fantastic. So I'm going to stop and I'm going to see you next week. Do you have any questions about the exam or whatever, any other housekeeping questions to ask? All good?
All good. Assignment is being
All
done.
good. Ah, very good. Oh, who said that, huh?
It has to be submitted by 6.
Ah, sure. Very enthusiastic students. Huh? I'm amazed. Huh? No, actually, I came back and told the director also that the crowd at in Dubai are amazing. You know, they ask the right questions. They are very intelligent, and I was very. I really enjoyed the sessions in Dubai. You know, this is good. All right, guys, I'm going to log off then. I'll see you next week then. If you have any questions, please email me.
What's the topic
Thank you very much.